Okay, so we have two things to talk today. So we'll have a brief introduction to brief levels. Okay, we should start from the content vocabulary 19. We didn't have this before exam. Okay, so we'll talk about here. But don't worry, what I will talk will be structured will never be your exam. So if you just have no interest on this, and we can do one class. Okay. So then that's a part whether frequency kind of four. Okay, I will leave 30 to 40 minutes to talk about them. This part will be that this part it comes to the section that we must cover. Okay, so for the Greek letters, okay, I have to continue from our previous story. Okay, so at least now I'm not really talking about that. Actually, talking about the outcome. At least you have heard about the risk-based portfolio construction, right? So in our binomial tree example, so we construct the risk-based portfolio using the sum, and then we eventually successfully derive the option price, right? And then using option price, think about the key major, Q major, C. So this is actually not the only way to derive the model. Okay, but this is the easy. This is the most understand. So here's a very small story. Maybe a very small story. So if you check the Nobel Prize, it's three guys, Jack Soros, Morgan, they are actually two teams. Okay, and although their contribution they get into the literature, which leads to Nobel Prize, both are saying talking about the derivative pricing, but they have the result on different methods. So Fisher-Black and Magnus Morse, they first cooperate, and their method is they first get into CAPM. Because a CAPM framework actually give you an easy way to thinking about any risky assets expected return. Right. So by building the relationship between the option expected return and stock return, and also then building the relationship between stock return, the risk of return, market return. So they first measure the P star, which is the physical probability for the upward movement, and then they use the P star to divide that. Okay. So instead, what Robert Morton did is quite similar to what we introduced in the class. So what Morton did is that he first constructed risk portfolio and argued that this risk portfolio definitely have the risk-free return, and he derived the P, the risk neutral probability of portfolio, and he used the P to derive that. Okay, so we can try to formalize it a little bit. Okay, I will even okay, then you understand this again. This will now be your exam. Well, you just enjoy it. You pay the tuition fee for the calculation. Sounds interesting. Okay, so we know that the risk is you should have the proper delta, right? So this delta is actually the first order partial derivatives in the cells. Yes, the underlying asset price. Okay, so you can write the sorry this way. You short one derivative. Whether this derivative is option, future, and other things actually doesn't matter. This model can apply to all derivatives. In short one derivative, and the log of F of S shares. It is the right? So I didn't do anything new. Just defining the risk volume as we had before. So then with this combination, we know that this is delta. So we can try to express the portfolio values for now, the current time point, not the end, current time point, by writing them into this. Okay, this delta, this F, basically at 0, current constant price, and short the derivative. This is the F. Okay, so we use this this to represent portfolio value now. Okay, this is our portfolio. We invest this amount of money. So what Merton argued is that at least we still a short time period, we see a very short time. This risk-based portfolio is perfect. Okay, we know that if we extend that into a very long time period, the delta itself may change. Okay, depending on different markets, the delta itself may not be constant all the time. Right. So in a very long time, this portfolio may not be big amounts clear share amount. But at least within a short time period, let's say this short time period is still T. Okay. At least within this short time period, which like is not long enough for delta to change substantially, then the risk is portfolio now is perfect. Then this perfect risk portfolio should generate risk of free return. Okay, according to the market equation for that arbitrary assumption. So that means the change of the portfolio value. So here this delta is not available. Okay, and this delta I, this is the spot term, single term. This is referring to the change of portfolio value from one time point to another. This one, okay, from now on point, this should be a risk-free rate. But that means this one should be equal to risk-free rate multiplied by itself and minus. Okay, so this equation looks very simple. So this equation is actually, if you check back to the numerical example we have about trade, this equation is actually the one for 20 delta minus F equals to 4.415. Okay, so you can check it on. So we know that pi here is defined as that research of the portfolio value. So the pi was pi. Okay, so we can substitute pi. So substitute pi, this is delta this. So this already means a differentiation of course of the derivative. So put it to this part. Okay, there are some mathematical problems here. Okay, you don't need to understand it. Even for me, I did that 10 years ago. I forgot it already. Yeah, okay. There's no where to apply it. Don't worry. So there are some mathematical ways to kind of clean this. Okay, so replace something to pi, you will have something like this. At least the this part is minus 0, right? So you then reallocate rearrange the segments of first this. So your first order partial derivatives against T plus S multiplied your first order partial derivative against S plus simplify sigma square F square multiplied with second order equals to risk of the rate. But your derivative price. Okay, so this one, sometimes in Python internet content is shown as a and yes, that's it. That's it. Okay. If you solve this with specific condition, you will exactly have the same yes as what we had before. Okay. So the powerful part of this formula is combining these different constraints, you will solve for different derivatives parts. Okay, so if you set that at t equals the capital T, okay, means at the maturity, the distributive have a certain value which is the maximum of this tool. Okay, this is basically a expression of the call method. So combine this formula, this position, you will solve the output price. Okay, if you change this order condition a little bit by changing the second here to k minus s, this is the return for put option, right? So if you combine this formula with this one, you will solve for put option prices. Or if you set that at the terminal, at the maturity, the F is exactly equals to the stock price. This condition combined with this will lead to the future price. Okay, so if F equals less than P, then you solve the estimated first, you will eventually have to basic formula like this. Okay, so we can see the powerful part of Black-Scholes model. You can see that is why we the power formula, and just by changing some parameter like this order conditions, you can solve for different derivatives classes. Right. So you can solve for orders of futures of additive costs, and even if you design something very strange, actually in market we have many different not only counter, moon counter, futures, swaps, both forward rate improvements, okay, a lot of other options, other things, and just to replace the border condition a little bit, okay, you can easily derive a theoretically fair price for that new product. Okay, so we will say, actually, that's why I used to say that you don't need to be panicked about this course or this car. But I would say that the upper limit of this cost is not that high. Okay, after you learn all the thing, when you go to find a job or just say something about phase two, like if you go to the master program, even if you go to master, you should talk something more difficult. They can just talk about something significant. Okay? So sorry about saying, because until here, you are killing the whole area. You have a lot of here. This one sometimes. And so then after this overlap, you can see that what we can do in this derivative market is more about application. Okay, how to effectively use it, how to effectively use our tools rather than how to develop new things. Okay, because there's no difficulty for developing new things as long as you have this easily determine all single derivatives price. Right, so it's all about, by the end, it's all about application and eventually, I would say it almost huge this area. So, like for me, whether I could do some research about options, so my supervisor said no. Why? Because only a few person now working on this, like maybe 1%, 1%. So because after this model in 1970s, then comes 1990s. We have a lot of indicators this model, so that's nothing new. Nothing very new. Okay, you can still have some new stuff, but nothing very new at all. So you can see this is kind of the distribution of the price. You have very substantial contribution to the society, but sometimes to kill an error. Now nobody can make any meaningful research in this area because compared to lower price, every single time. Right. So this is actually the end of the PSL model. And I introduced this because to introduce a prerequisite one, it's not have back up here. Okay. Commonly in the markets, I would say that this is not only difficult to view, but difficult to cover the market. Don't worry, other people in the market is not smarter than you are able to view this one, how to understand. Okay, so they have some easier way by using those first order partial derivatives, all side of partial derivatives. I understand this model from different perspectives. Okay, and this is also connected to what we have in chapter 11. So at the beginning of chapter 11, we talk about harmony rates of open prices. We talk about some factors affecting open prices, right? We talk about these zero K, T, sigma, dividends, and so on and so on. We say, okay, each one factor they have multiple impact on the call, right? So actually, Greek letters has a formalization of that relationship. Okay, and so people referring to delta, people referring to gamma, theta, as things, they are actually referring to the factor relationship there. Okay, so let me tell you the story here. Okay, the first one, delta, you should be very familiar. Now, I hope so. I hope so. This is the first of yes, and this is the most commonly used Greek letter in the hedging strategy because very natural, right? When you're thinking about having option, having the future contracts, using the underlying asset is kind of best because theoretically they have for future price they have convergence, right? And for option you have the exercise. So the idea of having is that's about here. Okay. If you first hold some shares as a bank, holding that much shares is not a good story for you because you are not investing in yourself. So you can have your exposure, business exposure by sell some derivatives, for example, sell some options, then you are having a cover call position. Right. Then the delta here can determine optimal number of derivative you can sell for the shares you hold. Okay, so if the delta is 0.25, that means for 1,000 shares you hold, you can sell at most 4,000 options for these shares. Although, if the all options should be exercised at maturity, you need to buy maybe 3,000 from the market to fulfill the requirements. But at least from current perspective, also as a show making the total portfolio neutral as a zero, you are about to hedge any change in the asset value. So this is like zero and delta first order particular as this is like you are if this curve is the open price, you are actually tracking the slope of a certain point right now. So if you match the slope of your option as well as your other assets. That means if there is a $1 change, $1 increase your stock position, there should be another $1 decrease in your derivative position. So that in total, although I change your total, this is the idea of delta management. Okay, so delta management based on delta neutral strategy, delta hedging, like delta neutral strategy, delta neutral policy, these are the things, okay? So all the things are like referring delta, thinking about direction control and slope. But is that all sorry? So we know that the BSM model is actually a nonlinear function. It involves some result model distribution. So we know that if the stock price move from here to here, then your option price from here to here. This movement comparing to a linear function, the difference from here to here, the distance from here to here is not the same. Sometimes the difference can be very high. So with the nonlinear function, so if the curvature of the function is very high, then your delta hedging strategy will have more bias accordingly. So that means you cannot only control for slope, but you can also consider the curvature. If you having required for larger scale of movements. But for curvature, some second order partial derivative. This one is called gamma. Okay. Second order. This one, this is the slope measure. This one measures the curve, right? So if you want to control the curvature as well, then we make the delta neutral. Also, you can make it gamma neutral. So if both are zero for the whole delta, right? So the sigma here is the first order partial derivative against t against time. So this is your option, or this is your derivative price sensitivity to time length to the maturity. Right. This one is actually part of this story, part of this delta neutral strategy, because if you get here, you will magnify this. The Greek letters appears at the end here. Okay, alpha f of the t is the zeta. As alpha as is delta. Alpha square is the alpha. Okay, and alpha is actually both constant. And you can also observe very large and observe the So what you can get from this? So if you have a delta neutral strategy, so this term is zero, okay? Delta neutral strategy is zero, but the whole portfolio is zero. Then the only thing remains is the theta and gamma. The summation of them also very small constant. Okay, it's much close to zero. That means what? Means if this curvature is popular, this curvature is positive. If this is a very large value, this one will also be very large, and then a very large negative value. Okay, so that means the whole story for delta hedging is that if you are running a delta hedging strategy and if you want to additionally hedge about the large scale movement, then this large scale movement will happen from gamma or sigma actually the same. And in addition to that, okay, so in the values business strategy, if you are additionally about large scale movements, I sigma and gamma. They are the same because the right only once your delta is zero, they should have same all same value in the side minus negative plus one. Okay, so this is really the whole story. Okay, so whole story is so all the direction, pay the same value. Omega and rho, they are personal boundaries against volatility, personal boundaries against risk variability. So let's focus on question from a different perspective. Okay. So thinking about the problem using the real dollar change, right? So if the underlying asset value change $1, my derivative position should change accordingly for $1. Okay, so another way is just ignore all the number of the sum of money amount change. Rather you are from a different perspective, which is uncertainty. Okay, so controlling for omega is this like describing this way. Okay, so you can have the layout of your option, right? And you know that this will that is a positive value as well as the sigma so the question here is that if you can calculate the data option, you can also calculate the data for the for anything for real and overall what we call in the portfolio also comparing data for this. Okay, this is a analysis. So by passing the data, you can control the portfolio value in a totally different way. So these different ways, we are not releasing about value change in the past. But you think about that, I don't really care about direction of the change. I really care about whether increase, decrease for any certain amount of value, but I care about their uncertainty. Okay, if I control the uncertainty, I somehow manage the expires. So there's an artist some people is for value from percent is some people they're 50% is still very well. So you can buy stuff. Then all the sometimes managing the risk is kind of very time consuming because in long term the delta itself also change. That means today you use one share to match 4 options. Maybe next month you use one option to match 3 shares. Right. And then you need to keep selling, purchasing, to make your position have a delta neutral value. It actually quite very consuming. So you can have some perspective and enjoy backup and no. Okay, so this is the whole story. And then they have drawn market, they say, now let me address you. So the idea from derivatives is not only for derivatives, it's also for any portfolio. So you can very easily get some very simple draw that management company. They also care about building. They also care about different photo performance. They got the photo have more options and features. So getting this concept is very helpful. Okay, so this is our whole story for pre-campus. So we spent 37 minutes here since that's okay. So well, let me understand this again. We won't have anything in the exam. Okay, we'll care about it. We'll care about it. So it just will be helpful when you try to find a job. Okay. So we can get back to something easier, interesting. Oh, okay. Level is so lagging, so we can get to chapter 4. Okay, I guess some of you may feel confused that why we talk about option first, although the chapters are much much later than interest rates. Okay, why we talk about chapter 10, 11, 12, 13, even 19 and 20, something come back to first. Okay, so this is because for futures and options, our consideration is that even if you don't find a job in the finance industry, future and options, the knowledge for future and options is still helpful for you because I need to use videos they can open accounts for derivative trading and what they can trade expensive futures and options. Okay, so even if you give up major, okay, after graduate, that was thinking about finance anymore. That's okay, but still, in the future, like 10 years later, 20 years later, if there is any chance for you to trade derivatives, the knowledge for futures options still important, still matters to you. Okay, that's why we believe that even if the all option content is actually quite complicated because it's by Ian Hartman, yes, model. Instead comes to the content regarding interest rate, regarding forward interest rate agreement, regarding the swap and they are more specific. Okay, you will never see any video talking about that. Okay, yesterday I just buy in swap is what. That's not common, not common at all. Okay, because for individuals, usually the swap is not designed for individuals. Okay, later you can see the content you will see. And the main concern or the main problem here is that it's just so complicated or it's just so opaque for normal people thinking about their exposure to the interest rate. Okay, swap is more or less a management of your interest rate exposure. Okay, So this is talking about interest rate, that's talking about interest rate futures, and then in the next of that, we talk about the swaps. All the products, all the things you are about is about the interest rate management. But for normal people, it's hard to let them aware about their exposure to interest rate. Although everyone more or less have their exposure to interest rate. Okay, like if you in the future, right, you want to buy your own house, right? You need to consider about whether I should use my own money or I should borrow from the bank, use mortgage. It's not about why I'm just so rich. I don't care. I don't care that I will just use the money. Okay, it's not the case. It's not the case. Trust me. The problem is that you also always need to measure about whether it's more efficient, it's cheaper for you to use your money, or it is cheaper for you to use the mortgage. Mortgage has some cost, right? But if you're using your own money, you also have operating cost. Okay, imagine that you are a manufacturer, you are a rich person, and you hold a lot of factories. So now yes, you may have several million Chinese yuan in your pocket. That can be definitely enough for you to buy a house. But the problem is, do you really use it for the house, or is it better for you to fund another factory to run to enlarge your business? That's the question, right? Because if thinking about that, now you have this several million in your pockets. If you put into your own business, the one you're very familiar with, so you open another new factory, okay, increase your productivity a lot. The overall NPV, like the overall IRR of this investment, maybe 5%, 7% per annum. It can be a good deal for you. But if you use it to buy a house, and you give up that 5%, 7% investment. Right. And if you now just use it into your factory funding, okay, you use that money into your factory funding, and for the house, you still want to buy it, you borrow from the mortgage, borrow from the bank, and the borrowing rate maybe in the US it's 5%, in Canada it's about 8%. Comparably, you use the money to invest for a 7% return project, and you borrow money with a cost, like in China, just 1.8%. And this is so fair. Like for a business, if I can do this, right, I will repeat this cycle as much as possible. Then I will try to borrow as much as possible from the bank if the bank loan is so cheap and the investment factor. So everyone have the exposure to the interest rate. Just it is very hard to be aware about. People tend to thinking about the events alone. People tend to think about, oh, this year I borrow from bank for 2%. Next year I borrow from bank interest rate is about 8%. Oh, this year is cheaper. Right. Maybe next year your investment return also decreases. So the story. The investment side, the borrowing side, the financing side, all connected, right? So it's very, very opaque, very less transparent for normal people to think about their exposure to interest rates. So, and this is the other reason for us to improve the interest rate curve the last part of this semester. But don't worry, really don't worry. After the second exam, you already finished all the difficult part. Okay, also we still have 3 more chapters, but trust me, those new 3 more chapters are much easier. Okay, so congratulations, I would say. You already finished the most difficult part. There's nothing much more difficult later. Okay, so take it easy. Okay, so come back to the interest rate story. So you know that everyone have their exposure to interest rate. It's hard for you to compare, and people are reluctant to bet about it. And it is it's not very hard to implement because the individuals that are really a few tools for you to manage the interest rate exposure. Okay, but this story is not the same for those large institutions. The large institutions, interest rate is their life, is their roots. Because interest rate is all of the care about. Because the consideration of that, consideration of any financial institution is not even, it's not the same as us as individuals. Like for us, we save cash, we deposit cash into the bank, we learn the risk-free rate. We are so happy. We buy some security, put it into our security account, just put it there. I buy Apple stock, I leave it there for 2 years, I didn't check about it. But because for me, that is like long-term investment, there I expect have a long-term growth, value gain, it's a thing that we can. But this story is definitely not true for banks. For banks, okay, the primary idea for any financial institutions, okay, their primary idea is everything should flow. Everything should flow. That you remember that. Okay, that means there's nothing should stop your hand for those financial institutions. Okay, cash, no, don't keep it. Cash is like some birthing. Okay, you keep it for 1 day, the cash value considered our risk-free rate. If you keep it for 1 day, you are actually losing money. Okay, so for you, for bank strategies, by any time, by any chance, anytime you get new deposit in, you need to lend it out immediately, as soon as possible, to lend lending rate. Also, for those securities, you got to buy a lot of securities, right? There are some Basel III regulation require banks to have their to have enough capital to maintain the overall bank system stability. Right. You have those securities, but keeping that security is good. Okay, you need to somehow back in the lower the market, keep earning interest. That's the common sense for that. Okay, everything should flow. Anything stop your hand, that's beauty. That's beauty. That means you are inefficiently managing those assets. Okay, so this turns to some story about computer. Okay. Here today we only cover one single question, which is that okay, so if the interest rate is so important, then which interest rate we should use as our reference? Okay, we have several different choices, right? So the easiest one that is the primary rate. This is a US dollar rate. Okay. But in different countries, you can also use your home countries. In the financial market now, at least because the US economy is the largest economy, their treasury bond also has largest size of the world. So and also the liquidity is very high. So considerably comparing all so values in power. Okay. US very well, highest total highest liquidity, so this can be used as the reference for how we set the rate. Okay, but this is somehow problematic. We are talking about probably being tax-free nowadays. So just put it there. Okay, so next, this overnight risk. This story connected to what I talked about. Okay, this is story here is that actually have some overnights lending and borrowing. Okay, I don't know whether you understand it. Okay, so I will have a story. So for a single bank, let's use an example. BOC, okay, Bank of China. Okay, so Bank of China in China, we have all the world, we have hundreds of different branches. Right? And every day, each branches they will have their business. Right? So new people come in, put in money, release money, and also they will make the business about lending. Okay, they learn how to do videos. The small amount lending is what you use in credit card. Okay, you swipe a credit card. That's actually a calculated lending. And then later next month, you will use your deposit to cover your outstanding liability to your credit card. This is like you are using the deposit to cover your borrowing from the bank. Okay. So also the bank has large liability to customers and institutions. So the flow is like this. So every day the bank has some cash flow. So this can be deposited. This can be debt repayment from some company, and so on and so on. And you also have some cash flows. Okay, this may be from some purchase credit card expense. This may be your lending to a company. This may be some deposit redemption. Okay, so they say like 1,000 US salary back, and then by that they redeem the maybe 500 from the bank, so on. So they actually block cash flow. So the problem is that it's very hard to thinking about that every day these two can match each other. Very likely that for your bank maybe today you collect a lot of people and that repayment because this is just the day for the that repayment you receive 10 million. But unfortunately, today you don't have any new deal. Okay, you don't have any new deal with a company. You just have some credit card expense, some reduction, all very small. So today what you spend is just 0.5 million. Okay. So this means what? It means that today you receive by the night of the day, after your working hour, 5 p.m. maybe, you have so much cash, your cash balance. Right. So you are in a cash balance surplus. This is guilty. You have so much cash in your balance, you didn't find a way to use it. It stayed in your account for at least 1 night. Okay, if you can find somewhere to lend it out, at least for this 1 night, this 10 million, right? Even if the interest rate for 1 year is just 2%, like you lend it for 1 day, you still get several thousand. Right? So this is good. And what's more, you have surplus, this is a problem for you. You didn't expect about it. What's more, if today you get less deposit, but you just make a very large deal. Okay, you agree with the company, right? The POC that use real that. Okay, you lend out a very large amount, like 1 million, to open another factory, like manufacturing grain. Okay, so here today you are lend out 1 billion, but you just receive like several million, 1 million deposit, that repayment. So you are in a cash balance deficit by the night of the day. This is quite a severe problem because what if next day the first one knocking you for is the deposit and the depositor say, I want to redeem what's on the first one. You will be panic because today I already lend out a billion. I have no cash. Okay, maybe before I have some several billion cash in the balance what they will have. And then the next day the deposit about my home. I have nothing to pay. That means what? As a bank, I default. This is the worst situation I expect. This worst situation. And you always forward. Right? So you get cash surplus, this is security. You got cash in deficit. This is all even more severe problem. Right. So for all banks, they need to make their cash balance like fair, you need necessary level. Okay, that you keep the minimum amount of cash that can just fulfill the next day's daily operation requirements. Okay, just make sure the next day and any redemption, any credit card payment, those that will be fought. Okay, you want to keep the minimum value. You don't want to get more, you want to get less. So this is a charge done by yourself. But this is easier if you have different value system. Okay, so actually there is a different learning system which is three. So different learning system is that within the night, they will try to borrow and lend each other. So those with cash surplus, they lend out to those with cash deficit. Okay, so by the next day, those with cash deficit, they got some cash from other banks. Okay, so they will have default risk. And those with cash surplus, because they lend out this money with cash deficit, they can earn some interest rate from that one. Okay, so this is a leading strategy. Okay? And this leading strategy can have interest rates, okay, depending on demand and supply at the end. So we call this overnight rates. In different countries have different name for this. In the US, this is called platform rates. Okay, because by the end, the minimum cash balance you want to keep for your next day's daily operation is actually older, actually regulated by the central bank. Okay, the central bank will have cash ratio. Chinese is called 中环储备金率. Okay, the bank will have a requirement. So this requires you to have a certain ratio of money according to the total asset. So this cash from the central bank perspective, this is enough for you to manage your assets. Okay, so to maintain this cash balance, okay, we can overnight market every day. Okay, so and the interest rate overnight market is overnight interest rate. So definitely different banks have different transactions. Some banks are interest rates will be higher, some banks will be lower. So the reported Fed fund rate for that interest rate is the weighted average. Okay. So you can see that from the story here, this virtually this story is a risk-free process. Prices. The overnight borrowing lending happens with large banks, large institutions, and the time is very short, one night only. Short time, very responsive borrower and lenders, and they are all very well regulated by the government. So all the aspects suggest that this interest rate should be observed within risk-free investment. Okay, so this is why it's viewed as a reference for risk. Okay. The next is report rate. So report rate referring to repurchase. Okay, this is like revision. So as I just said, in the balance system, okay, or in any financial institution, everything should flow. Okay, cash should flow, so it by the end lead to the overnight borrowing and lending. Security should also flow. Okay, you know that banks have the requirement like Basel II, Basel III, those regulations. Okay, you need to keep this asset, make sure that you don't make the whole banking system have systematic risk, right? So in addition to those cash, you also have securities. Okay, various Normally, when you hold the government bond, some municipal bonds, some banks, okay, after the quantitative easing, after 2008 financial crisis, some large banks in the US even hold the stocks. Okay, everything should flow. So keeping those bonds and stocks in your balance as security, you don't utilize it very well. Okay, so here, the optimal strategy for that is that how about I temporarily lend all those securities out to the market, and I can get some money from the person. Okay, so like for example, if I have one treasury bond was just 1,000 US dollar. So if I keep this bond, yes, it is worth $1,000. I cannot really use it. So to me, the good strategy is how about I lend it out for a short time, just 1 week, and then because I lend it out, one borrow my bond, they need to first deposit 1,000 US dollar to me as their margin, as their collateral. Then I can use this 1,000 US dollar to do this and that, right? To run my business. 7 days later, I say I will repurchase back the security I just lent out, okay, by paying you a slightly higher amount. Like today, I lend it out to you for a week, okay, and you deposit 1,000 US dollar to me. 1 week later, okay, I repurchase that from you with a relatively higher price and pay you $1,010. This is a fair strategy, right? I got the liquidity. This is important. I got the liquidity. Okay, compared to just hold a single security, got 1,000 US dollar liquidity. I can do that within this week. And the borrower, the one temporarily hold my treasury, hold my bonds, they got the interest rate and pay. Right. So this is also called repurchasing. Okay, by the time you temporarily sell it out, it's actually concept is more like lend out. Okay, by the time you sell it out, you determine the time you want to repurchase it back, and also determine the repurchase rate you want to apply this repurchase also. Okay. So we can see that this part on this part, the summary is quite similar to online lending. Online lending happens within large banks, large institutions, very well regulated by the governments. Happens within a very short time period. Repurchase also. Repurchase kind of like online purchase. 2 days repurchase, I think, at most 7 days, different country, different place, different recommendation. Okay. The Europe, our common is just 1 day, 3 days. Short time, very well regulated by governments. Happens to be seen large. So still, you can see that everything here. Actually make sure that report rate is a good reference for risk of variation. Unfortunately, the environment for repurchase is supportive of risk of variation. Okay. So I want to leave some time. So because some of you will check the exam paper, I would say this part of the exam result is really disappointing because I don't want to spend all the questions I exactly in the past. And if you don't believe, you can go back and search in YouTube. We have our card recording. You can see that. Actually, all the questions, just the number of all the questions in the like I did write it down. Okay, so you should know, but I understand. I understand many of you just you find your final sentence a little bit about it. It's okay. I don't have the same experience. Okay? I was last year, I didn't go to class at all. Okay, so I understand. But still, this you cannot complain this way. I cannot complain. You don't really listen to me. You don't really listen to class. You really don't understand the exam outcome is terrible. You should accept it. Right. So that's it. Let me check the attendance. So finish. Attendance always will secure your safety. 陈思阳、陈新宇、陈新宇 sent。陈玉 sent。范一红 sent。高翔 sent。Obligation. Yes. So, okay. OK. 李玉和沈其胜 sent。沈文宇、孙守航。孙伟来了。是去的是杨楚浩，对吧？赵家的朱浩然、朱小航是一起。Okay, so that's all for today. That's all.